How easy money nearly destroyed his business, the dangerous illusion of fast profits. The fastest way to lose discipline is to make money too easily. Not slowly, not through struggle, but suddenly, effortlessly, repeatedly. Because when money starts flowing without resistance, judgment often starts fading with it. This is the story of a founder who didn't fail because he lacked intelligence. He failed because success came too fast. Ethan launched a digital marketing agency straight out of university. He had skill, confidence, and just enough experience to land his first few clients. At the beginning, everything felt uncertain. He negotiated carefully. He tracked expenses obsessively. He reinvested cautiously. Every dollar mattered. Then the market shifted. Small businesses suddenly rushed online, desperate for visibility. Demand for digital services exploded. Ethan's inbox filled daily with new leads. Clients didn't negotiate prices. They accepted proposals instantly. Campaigns delivered strong results because competition was low. Revenue tripled in 6 months. For the first time, money felt easy. Ethan hired quickly, upgraded offices, increased ad spend aggressively. He stopped scrutinizing expenses the way he once had. After all, revenue kept climbing. Profit margins were wide. Cash reserves were healthy. And here's the subtle shift that happens with easy money. You begin confusing momentum with mastery. Ethan believed the growth was proof of superior strategy. He told himself the market had validated his vision. But in reality, timing had amplified his results. When clients requested additional services outside the agency's expertise, Ethan said yes. Why not? Revenue was strong. He launched new service lines without testing profitability. He hired friends without evaluating skill fit. He entered partnerships without detailed contracts. Each decision felt low risk because cash flow covered mistakes. The team expanded rapidly. Internal processes lagged behind. Quality control weakened. But revenue still looked impressive on spreadsheets, so concerns were postponed. Easy money masks inefficiency. Then the market cooled. Competition increased. Advertising costs rose. Clients became selective. Results were harder to deliver. New leads slowed. For the first time in over a year, revenue didn't grow month over month. At first, Ethan brushed it off as seasonal fluctuation. But then 2 large clients left simultaneously, citing inconsistent performance. Cash flow tightened. Expenses remained high because they had scaled aggressively during peak months. The same decisions that felt bold during growth now felt reckless. The expanded team required salaries regardless of client volume. The office lease was long-term. Software subscriptions accumulated. Marketing spend had been optimized for expansion, not efficiency. Ethan realized something uncomfortable. The business had grown wider, not stronger. There's a critical difference between sustainable profit and temporary surplus. Sustainable profit is built on repeatable systems and disciplined margins. Temporary surplus is inflated by favorable conditions. Ethan had mistaken one for the other. As pressure mounted, cracks became visible. Some of the new service lines were unprofitable. Several hires were underperforming. Client churn was increasing. And because systems were loosely built, fixing issues required manual effort instead of automated stability. The turning point came during a late-night financial review. Ethan compared current numbers to the early days of the company. Back then, revenue was smaller but margins were tighter. Processes were lean. Clients were carefully selected. Growth was slower but controlled. Now, despite higher total revenue, stress was greater and predictability was weaker. He faced a choice: cut costs aggressively and stabilize, or gamble on another wave of easy growth. This is where many entrepreneurs double down. They chase new opportunities to escape structural problems. They assume one big client will fix everything. But that mindset is often a continuation of the same error, relying on momentum instead of discipline. Ethan chose differently. He initiated a full internal audit. Every service line was evaluated for profitability. Unprofitable offerings were eliminated. Hiring froze. Some roles were consolidated. Office space was reduced. Marketing spend shifted from aggressive expansion to targeted retention. It wasn't glamorous. It wasn't exciting. Revenue dipped temporarily, but margins improved. More importantly, discipline returned. The team restructured workflows. Performance metrics became transparent. Client onboarding was standardized. Instead of saying yes to every opportunity, Ethan began qualifying clients rigorously. The focus shifted from volume to value. Over time, the business stabilized. Revenue wasn't exploding anymore, but it was predictable. Cash flow became manageable. Stress levels decreased, and the company developed resilience it never had during its peak. Ethan later reflected on what nearly destroyed the business. It wasn't the downturn. It was complacency during the upturn. Easy money creates psychological distortion. It convinces you that risk has decreased when it has actually increased. It encourages expansion without scrutiny. It rewards speed over structure. When profits come effortlessly, the discipline that created the opportunity in the first place can quietly erode. There's a deeper lesson here beyond entrepreneurship. In investing, sudden gains can tempt reckless allocation. In careers, rapid promotions can inflate confidence beyond competence. In personal finance, unexpected windfalls can increase lifestyle costs faster than income sustainability. Easy money doesn't test your strategy. Hard conditions do. And if your systems only work when conditions are favorable, they aren't systems. They're circumstances. The goal in business is not to maximize short-term revenue spikes. It's to build a structure that survives volatility. Ethan's agency eventually regained steady growth, but it grew differently. Expansion decisions required profitability models. New hires followed workload forecasts. Partnerships required written agreements. Revenue was measured not just by total amount, but by quality and retention. The irony is that after discipline returned, profitability became more consistent than during the easy money period. Because discipline compounds, recklessness multiplies. The hidden danger of easy money isn't that it disappears. It's that it teaches you the wrong habits before it does. So if you're experiencing rapid success right now, unexpected contracts, strong investment returns, sudden income growth, pause for a moment. Ask yourself, are your systems strong enough to survive a slowdown? Or are they dependent on favorable conditions? If growth stopped tomorrow, would your structure hold? The market always cycles. Opportunities expand and contract. Timing changes. Competition evolves. What remains constant is discipline. And discipline is easiest to lose when you feel unstoppable. If this story resonated with you, remember that sustainable wealth is built during easy times by preparing for hard ones. Growth is exciting, but stability is powerful. If you found value in this episode of Wealth Narrative, take a moment to like the video and subscribe to the channel. We explore the decisions that shape long-term success, and sometimes the biggest risks hide inside your greatest wins.